Okay, let's answer some questions from the last market outlook. Some pretty detailed ones. I haven't read all the way through them, but there's some that are quite long. First one, with respect to your assertion about the Genius Act creating stablecoins that will create additional marginal demand for T-bills, where would this come from exactly? It would come from holders of the stablecoins to the extent that a consumer is willing to hold a stablecoin balance. Wouldn't it just be excess cash, which mostly sits in money market funds, being shuffled into another side? Why do you make the assumption that the existence of a stablecoin would draw money out of money market funds? Money sitting in money market funds are there for the return, not because it wants to be used in circulation as a currency. It's there for the return. A stablecoin is just another way to move money around the economy. Or I shouldn't say intra. Well, what would you need a stable coin for intra economy? I mean, if you're just going to the restaurant, just pay cash, pay credit card or debit card. Uh, the use cases for stable coins, that's sort of the big problem right now as well. What problem does it solve and how big is that problem? Um, the most obvious way is, let's think about a bank. It has assets and liabilities. It gets deposits. And these deposits go into three directions. About 10% of it goes into reserves, right? Most of it is earmarked for loans. But you need some liquidity management, so some of it goes into T-bills or treasuries, right? Because this person may come back and say, I want some of my money, so you need some kind of liquidity here. We'll put U.S. treasuries. It's a percentage. Let's call it 5% for fun. I don't even know if it'd be as much as 5%, but we'll call it 5% for fun. So you put $100 here, $5 will find its way into treasuries. If this person then says, well, you know what I want to do? I want to take this $100 and I want to put it in stable coins because I want to use it, then 100% of it must be in U.S. treasuries or T-bills. So you go from $5 to $100 in represented, because the Genius Act says that these must be backed dollar for dollar with treasuries. So what does the bank earn on this? Well, it earns the T-bill rate or the treasury rate on the whole float, which who knows if that's good or bad for them. It depends on what their opportunity cost was, which was, I guess, making loans. You also have big retailers that want to issue their own stable coin as well. Why? Because they don't want to pay the 3% discount fee on credit cards, the 2% or 3%. However, let's think about it from the use of the consumer. Where's my motivation to say, yeah, give me some of these things? Where's my motivation? I don't know that I have any unless I have a particular problem where I say this will solve a particular problem. But this is not a broad solution to anything. It's a very narrow solution to very particular problems that most people simply just do not have. So even though you have approval to say, yeah, go ahead, and you have retailers that would love to move to stablecoin instead of credit cards, and you have banks that are issuing stablecoins because they don't want to lose the 3% on their credit cards, you still have the consumer on the other side that says, yeah, well, what do I need this for, right? Additionally, I'm curious about how you are constructing a short S&P 493 plus long short cap position. Long short cap position. What's a short cap? Do you short the large cap index while holding a long position in MAGS? No, I'm not doing any of that. Right now I am short SPY and I am long IWM. Mostly on valuation. IWM has an extremely low valuation at the low $200 value, and SPY has an extremely high valuation sitting around the $600 value. So it's mostly just on valuation. Number one. Number two, I think going forward, AI will have a benefit for everyone, but I think that smaller caps will get a much larger benefit from AI because they have typically been resource constrained to begin with. The biggest resource is human resources. They've typically been human resource constrained to begin with. So this will allow them to increase their output, increase their productivity. Well, that extra output is going to start eating away over here. So I think these valuations will start to trend towards each other. or at least the valuation here will begin to drop, the valuation here will begin to increase. But if you did want to short the market while being long the Mag 7, you would, let's say if you sold $1,000 of SPY, you would be long, what is it, 30%? The top 7 are 30%. You'd be long $30 split among the 7 companies if you wanted to do it that way. Don't know why though. With respect to your TLT view, is the market really narrow enough for treasuries that it will cause a rise in yields due to positioning alone? Everything is due to positioning. Every price you see is due to positioning. Who's long? How many longs versus how many shorts, or how many dollars are long versus how many dollars are short? That's all positioning. Every single price everywhere is due to positioning. So I don't know that we have to think about a market being narrow or wide to end with the conclusion that the price is due to positioning. All prices are due to positioning. 100% of the price is due to positioning. If you don't take a position in something, you're not either pushing the price down or pushing the price up. If there's an asset and no one has a position in it, it has zero price. Every penny of every price is due entirely to positioning. Now, there could be reasons why you're positioning, but in the end, positioning is everything. If it was a split two markets, trading market versus investing market, there would be enough arbitrage to offset it in the market. Enough arbitrage? Who's arbitraging? What's the arb? No, I never made the case that there was any arb going on at all. It's opportunistic on both sides. Wouldn't we see more than the bid to... Okay, I'm not following any longer. More activity in the secondary market just because the yield is there to be picked up. Okay, yeah, I'm not following this one at all. I'll pass on that. Regarding bullish TLT stance, well, when I say bullish TLT stance, I think there's a lot of tailwinds. I think the headwinds right now are the traders selling every rip. Every rally is getting sold. This is not investors that are selling their bonds every time the price of the bond goes up. They're selling their bonds. I don't think that's what's going on. I think it's specifically traders coming into this market and opportunistically selling every rally on a narrative of budget deficits and debt. But in the bond world, there are bond funds. There's money that has to go into bonds. Where's it going to go? You don't like the U.S.? Fine. Pick something else. What are you going to pick? Like, what are you going to pick? So we got to get past this. And once we get past the idea that, well, yeah, maybe it's not the best situation, but what is? Where are you going to go? What are you going to take? Right? So I don't know that I'm saying that I'm bullish. It's just it's hard to be bearish at these high yields and lower prices. So I'm going to I'm just going to stay here. Could the rise in yields reflect not just short-term narrative distortion, but a broader regime shift towards structurally higher neutral rates, sustained fiscal deficit, and more long duration? Sure. You're putting forth a plausible argument. So there's plausible and there's probable. And then there's probable to the point that you'd put a bet on it. Yeah, that's plausible. And then there are some people who probably do believe that that is what the future is. I don't. I do not. I think that as technology finds its way into more and more and more of your everyday life, technology is deflationary. And it does democratize an industry because other smaller companies have access to the technology as well, which allows them to operate at a level higher than they would have 10 years ago. So while it's a plausible argument, sure, it's not one I buy into. While short interest rate is elevated, isn't it risky to lean on that as a contrarian signal? Who's leaning on a short interest rate as a contrarian signal, given that the crowded trades can stay crowded and painful for a long time? I don't know that I'm leaning on anything as a signal, given that crowded trades can... I mean, that's not saying anything. Crowded trades can stay crowded for a short period of time too. They can stay crowded for a medium period of time. They can fall apart tomorrow. They can, a market can stay irrational for a few minutes before it corrects. It can stay irrational for a few weeks or a year. I live in an area where it does rain, but the sun does shine. But I mean, if I leave my house every day with somebody saying, "Shouldn't you take an umbrella? It's been known to rain." Yeah, but it's been known to be sunny too. Uh, Crowded trades have been known to be crowded for a while. They've also been known to fall apart very quickly. So you're not really saying much there. How do stablecoins specifically support TLT when they could favor mostly T-bills or repo? Well, you force people, if you're sitting in the money market fund, if you run on a money market securities, and you need to buy, and there's no liquidity, you're going to move further out. You may move to the 6 month to the 1 year, which would then force the people in the 6 month to the 1 year to move out further. Not only that, the stablecoin bill allows for repos, right? So it's not just money market funds, because they realize that if this really takes off, let's say it turns into a $3 to $4 trillion additional demand for money market funds, they simply don't exist. The securities wouldn't exist. You'd be competing with corporate treasuries who want those as well. So what would end up happening is you drive so much money into the Fed for their reverse repo, because money market funds would say, we have no securities, that it would cost the Fed a lot of money. So it does allow for repos. So if a bank or anybody that issues stable coins needs a 30-day money market fund, they can do a repo. They can take their money and they can lend it to a hedge fund who buys a 10-year bond and offers the 10-year bond as collateral. From the lender's perspective, it is a 30-day repo secured by a treasury, because there won't be enough money market funds if it's successful. If it turns into a big thing, you have to always plan for success. Otherwise, you got a big problem. So by doing this, you will increase the liquidity in the treasury market by offering these repos. And that they can then just sit in a 30-day repo. I'm only sold on TLT for longer time horizon, primarily due to the potentially disinflationary impact of AI. Provocation: since you've admitted your timing is usually early, maybe this is one of those trades that only works if we all forget about it for a year. Maybe not. But maybe not. This is the thing about the future. It is unknowable. It's not that it's unknown. Unknown means I can figure it out, I just don't know it now. It is unknowable, meaning no matter what you do, you're not going to know it. Your actions today may actually change the future you're projecting. Your proclamations about what the future is going to be may actually influence people to act either in your favor or against you, thereby either making the very future you predicted because you have impact in the world, or denying the future because no one believes you. So, could be, but could be tomorrow. Could be today at 2:00 when the Fed cuts rates 100 basis points, and something bad happens in the world, and everyone realizes we're heading into a deflationary period, and all of this economic growth that we lived on with that required humans is gone, and by next week TLT could be at 110. It's plausible. Could happen, or it could not. All we can do is say, look, I've really thought about this. And I don't mind having exposure to the asset because it does provide a series of cash flows. I do get cash flow by holding on to it. At some point, I think it's going to perform. But since I don't know when it's going to perform, it's about time in the market as opposed to timing the market, right? To each his own. Every time I hear you about any topic, you always sound right to me, and I agree with you about everything. Okay. However, I try to think about any counter argument, but I can't. Well, now you have AI. You can take the text of whatever I say, you can put it into ChatGPT or Gemini, and you can tell it to actually argue against me, and it'll come out with a whole bunch of points against what I say. So whenever you come up with an idea, you say, this is what I believe. Type it in there and tell the AI to counter your points. Some of the points are, yeah, you can dismiss them. Some of them are, oh, I never thought of that. Right? I've been doing the MicroStrategy Bitcoin trade for a while, and I've created a Python code to compute NAV. I do it as follows: assets, liabilities, number of shares. Okay. I update it whenever they file an 8K announcement. Okay. This yields a much lower NAV, 105 a share, and a much higher MNAV than simply dividing the value of the Bitcoin by the number of shares. This makes sense as I'm accounting for liabilities. Okay. Discussion alliance needs to roll on a simpler method: Bitcoin divided by market cap. Market cap divided by Bitcoin, right? This is the metric. Market cap divided by Bitcoin or Bitcoin. I don't know what number you're trying to come up with there or how you're using it. So we'll go with yours. You and everyone else seem to be tracking. I don't see why we would ignore the liabilities when calculating NAV. Well, I guess you wouldn't. You would have to sell if we go on the basis that you'd have to sell some of the Bitcoin to pay off the debt, which they'll probably not do. What Saylor will probably do is issue preferred shares to pay off the debt. But if we just assume that you'd sell off the Bitcoin to pay off the debt, what is left. Yeah, I see what point you're making. The debt isn't really that big based on just the sheer holding of the Bitcoin. The debt's really not that big. And I think one of the issues is already, I think one of them is already in the money. I don't see why we would ignore the liabilities when calculating NAV or setting a price target. We wouldn't do that when calculating NAV. Financial institution. Real and increasingly significant liabilities. Well, no, they're not really increasing liabilities because he's shifted to issuing common shares and preferred shares and less so on the debt. I don't know if he has any plans to continue with the debt. The preferred shares, as he said on CNBC at one point, or whether it was on Bloomberg, he almost laughed at the shareholders who are buying this stuff. He says, we're issuing these things at 10% yield, of which we don't even have to pay if we don't want, and it's not even cumulative. So in his mind, I would, here's the thing, I'd be surprised if any of these preferred shareholders got a single penny in that 10% yield. I would be surprised. If you read the prospectus for these things, the dividend can be ignored. It could be paid in cash or it could be paid in shares. If he finds that he can't issue any more preferreds because he's simply not paying cash, he'll start paying it in shares, which would even be more dilutive. This is a one-way train wreck going on. I get what you're doing. Yeah, you could do what you're doing. You could do what you're doing, I guess. Caught the Washington military parade the other day. Looks like the orange guy's losing the parade Olympics to his BFFs, Vlad, Xi, Kim. Yeah, I think they were all sitting back with secondhand embarrassment going, you call that a military parade? Your soldiers aren't even walking in unison. Did you see when the groups would walk by? They weren't even walking in unison, and they weren't really even marching. They were sort of just strolling down the road. So I think, yeah, the other dictators are going, you call that a military parade? I watched it for a while. It really was almost sad. It was really sad. I guess U.S. troops just aren't trained for the all-important skill of goose stepping in perfect sync. Is he trying that hard to join the dictator club that he's now copying their parades? Well, I think what would have worked out better, you have a whole bunch of forts spread around the U.S., like here. He tried to get them all to go to Washington. Why not just open up each one to the local community around there and do a tour and say, here's what the Army, celebrate 250 years at each of these things if you wanted to celebrate the Army. But he used the 250th anniversary as a cover for his 79th birthday military parade, and it was pretty pathetic as far as military parades go. It was pretty pathetic. If you watched it, it was pretty pathetic. May I ask for your insight? One more thing on that. It was actually kind of interesting at the beginning because they went back and they had groups of people walking through in the military garb of the day and sometimes with the equipment of the day, and the announcer was explaining each period of time. I thought that was kind of interesting. It was kind of like a nice little military museum that was going past you. But then it just got when the Sherman, at the point of the Sherman tanks and there was like a couple of them. It was pretty bad. Either you do one or you don't. And this was doing one for the sake of doing one. And then Trump after that said it was a great success. They were forecasting a 100% chance of rain, but while we were sitting there, not one drop of rain landed on this parade. It's like, May I ask for your insights on the benefit of the Fed's cutting? Well, the biggest benefit right away is interest expense for the government. Interest expense. So if you think about how much they issue in T-bills, right? That would be going out instead of at 4.33%, would now be going out at 4.08% or even lower. It would begin to lessen the burden on U.S. finances. It would begin to lower the projected amount of the deficit over the next 10 years if you can get that interest expense down. So there's the first benefit that could happen right away. Every dollar that's paid out in interest has got to come from you. It's got to come from the American citizens somewhere. So you got to be taxed for it somewhere. So if you don't have to pay it, you don't have to be taxed for it somewhere. That's the first benefit right there. And if it has any benefit on the long end of the curve, let's say 25 basis points gets the 10-year down by 10 basis points. Well, mortgage rates would probably fall in lockstep by 10 basis points. If the 5-year dropped by 15 basis points, car loans would drop by 15 basis points, right? All of it would be a benefit for consumers. The people who would suffer are the people who receive the interest payments, because it'd be like, well, I'm getting less in interest payments now. If growth is slowing and unemployment will only worsen with AI, how will the cut really help when it sounds like you are alluding to structural unemployment being the looming key issue? Well, you encourage investment. The lower the discount rate and whenever you decide to invest, you'll do some capital budgeting and you'll discount all those future cash flows to today to see if you have a project that has a positive NPV, net present value. The lower the discount rate, the more likely more projects are to be net present value positive, the more investment you would get, which would create employment. But if you have employment which is getting hard to find and high rates so that investment is really low, you don't have new jobs being created. So that's an exacerbation of the problem. That is a word, right? Problem. Is it not a fiscal policy and thoughtfulness on the value of human capital? Is it not a fiscal policy and thoughtfulness on the value of human capital more necessary than a monetary decision? I don't understand what you're asking there. Otherwise, reducing rates will improve the cost of productivity. The cost of productivity, but productivity of the population. Okay, I have no idea what you're saying there, so I'm going to pass on that one. Why would anyone pay through stablecoins when the merchant is the one who bears the processing fees? True, I agree. Even if they offer some sort of cashback or rebate, I would never keep my money in a retailer's account, so I don't understand what the incentive is. Same here. I don't know. Let's say that stablecoins break out and my bank says, hey, we got stablecoins for you. Costco says, hey, we got stablecoins for you. So I'm good. I have my debit card. I'm good. Why would I have money deposited into my bank account, take that money, turn it into stable coins, go somewhere, pay for the stable coins when I could say, why do the round trip? Money gets deposited in my bank account, I take my debit card, I go buy something. What, you don't take cash anymore? Right? I mean, like, why? I've been critical of the whole crypto space. That I've said it before. It is a wonderful, elegant, mathematically beautiful solution to a problem almost nobody has. Right? So even though you can create stable coins and you can see the benefit for the retailers to avoid that 3%, and there are some use cases where you say that would make a lot of sense. If I had some way to transfer on, very quickly using blockchain technology, but without all the volatility of Bitcoin and all the other cryptos, and without the risk of all these carpet pull and scam cryptos that are out there, because it is the wild west of thievery, fraud, scams. That's all in crypto. Um, so it does protect you from that part, but it still doesn't solve the problem of, great, what do I need it for? Well, you can buy stuff. I can buy stuff with cash. You can pay people. I can pay people with cash. Well, what if it's across the border? That's easy to do. It's so easy to do. I mean, the idea that people think it takes 2-3 days for money to transfer across the border. I can transfer money to a U.S. bank from a Canadian bank, in a phone call, 3 minutes, 4 minutes. I'm not kidding you. You can. I did 4.5 million, and it got there, all in no time. So this idea that it takes some time. Oh, by the way, that whole thing only cost $50 to do. When I did it, only cost $50, right? I did it for escrow. That's no problem. That was no problem. So, no matter what you bring up, and it always seems to go to the extreme. Yeah, but you can transfer a large sum of money across borders in seconds. Great. I'm thinking, when was the last time I had that problem where I go, if only I could transfer a large sum of money across borders in seconds. When was the last time I had that problem? Never. I don't know anybody with that problem, right? So I'm not saying that there aren't people who need to do that, but that market is so small. However, Bitcoin has a market cap of over $2 trillion, and I think it's a big pile of nonsense. I think it's just a big, giant pile of nonsense, and it has a market cap of over $2 trillion. So I think stablecoins have a 50% good argument for the retailer. But for the consumer, the other 50% of the argument isn't there, but Bitcoin has a market cap over $2 trillion. So who knows? Thoughts on AI being short-term inflationary? CapEx spent on hardware and salaries, leaders in space. Okay, so what you're saying is that you got to spend money on some things to get these things. It's going to be inflationary. No, that won't. Let's say that you're saying, well, the price of NVIDIA chips is high. But that's the price of a particular product. Inflation is a general, we're talking about general price level, right? So when we say something is inflationary, it means that if we think about the economy with a whole bunch of sub-industries, something is inflationary when it cuts across all the sub-industries. Something is not inflationary when within this particular industry, the price of something is rising. So if we say, well, the price of uranium is really going up because of all the interest in these modular nuclear facilities, that's not inflationary. That's just the price of something going up. That's a pricing signal to bring more supply online. Something is inflationary when it increases the broad price level. So investing in data centers, the chips are expensive, it's going to be inflationary. No, it's not. It just makes chips expensive. That's all. But it doesn't make everything across the board. It doesn't put general price pressure up on everything. So we can ignore that. Well, not ignore that, but I think we made that point. Regarding the Middle East, I have no issues with your logic. I think maybe a bit misinformed, or at the very least not seeing all reports. You know what? You can talk to anybody about anything, and unless the other person agrees with you, they'll tell you you're misinformed, right? I mean, I could do the same thing to you. I could say, well, you're only reading that stuff. I think you're grossly misinformed about the other stuff. There's no solution to that, right? You have a certain belief, and I have a certain belief, and you're going to tell me the information I'm seeing is incomplete, and I'm going to tell you the information you're seeing is incomplete, and there's never a resolution to those, so I'm not even going to read it. I'm wondering if you have any thoughts on the idea that if the Fed cuts rates to lower unemployment, they are also going to be squeezing capital into AI companies and making it easier for them to build out their new models. Well, that's called investment. Sure, sure. Some of that will go into AI companies. Some of it will, sure. Every new generation of AI models is likely to have larger impact on the labor market. I don't even think you, at this point, I don't think you need more models. The models that are out there are just getting better and better and better and better. So, you know, if you're just using Gemini, every couple of months, it just keeps getting better and better and better. So if that's all that existed, that would be threat enough. There are a whole bunch of models out there, some of them just nowhere near the capability of a Gemini or a Manus, that will eventually just go away or find some niche market that they'll be used in. But I don't know at this point that lowering rates is going to make this a bigger, badder genie. It's already a big, bad genie, and it's already out of the bottle, right? And it's already there. So I'm not sure that I would be hesitant on rate cuts because I'd want to slow down AI. You're not going to slow it down. And by the way, this is how technology works, right? It is rapid, right? When it has use cases, it is rapid. Bitcoin has been around for 15 years, 16 years now, 15, 16 years. Has it found its way? And I ask this question a lot. Has it found its way into your life in any meaningful way? If the answer is no, it's because it's nothing. It's because it's nothing. It's a neat little thing that I think is being misinterpreted as something else, but it's really nothing. Alongside this, I think pretty much any company, when presented with extra capital right now, is going to find a way to spend some of it on AI. Spend some of it on AI. You don't really have to spend a lot of money on AI. That's the thing. I mean, once you have these foundational models, these big models, you can build on these models rather easily. If I spend any of my time on AI, I quickly realize how much I can save in other parts of the organization. So it's not just that AI has been an added expense to me. It has been a reduction in expenses that I otherwise would have incurred. And almost a threat to my own identity, because as I keep using this more and more, I keep thinking there's very little room left for me here, it seems. Although I think I found my solution. I think I found a home I can live in for a while. But comma for now, whenever you say anything about AI. That means that even in places where low rates will create more jobs, will also generate even more demand for AI and sure, it'll generate more demand for AI. Of course it will. I don't know that I would use the word demand. It will, right now, it's adoption, right? Because it already exists. It already exists. It's not as if, and it's highly scalable. So I don't think we can talk in terms of demand. More demand for AI won't push up the price of AI. It'll just generate more revenue for Gemini, for OpenAI, etc. because it's scalable. It's entirely scalable. So I would say higher adoption rates, but higher adoption rates brings an organization closer to the realization that they don't need to hire as many people to do the same output, or they can get higher output with the people they have without having to bring new people on. Or they can just do the output they're doing with fewer people. There was a story in the Wall Street Journal today talking about, I forget what company it was. I'll be using it in my market outlook this weekend. That basically said straight out, I think it was Amazon, said straight out, we will be cutting our workforce because of AI. Blatantly, because of AI. And then it listed a bunch of other companies that said the same thing. We will be cutting because of AI. The faster the adoption rate, the faster this comes. Just want to add that European duration isn't performing as well since I have exposure to France and German long bonds, so it's not just a US thing. No, it is not. Additionally, could it be that US yields rose on Friday as a possibility that Israelis drag the USA into a conflict with Iran, which could result in further fiscal spending? You could see it that way. Usually, when you have heightened risk in the world, money tries to find a safe place to be. Right? You said you sold your CFA program prep business. Yep. I believe you must have done your own valuation on your business prior to the sale. Pretty much, yeah. Do you think or remember that you had priced in the development of AI tools? No, I did not. Or other AI controversial development for exam prep and study during the valuation? No, I did not. It was way too early in the process. It didn't, it was something on the horizon, way out there, without any clear value proposition for what I did. So in time, I'm sure it would have been something, but at the time, it really wasn't a consideration. Would you say your business would have been valued lower or higher, assuming the expected development of Gemini, ChatGPT, and overall AI? That's a good question. Well, it depends. Would I have had an AI strategy? If the answer is no, it would have been valued lower. If I did, it probably would have been valued about the same, because there are very tight formulas in private equity when you're taking out small private companies about what multiple you're paying and what the metric is, and how you determine a valuation. So you don't really have a lot of negotiating room on how your business is valued. It's going to be valued on a multiple of EBITDA. So you don't really have a lot of negotiating room there, saying, "Oh, value me on sales, value me on this." It's a multiple of EBITDA. Where you do have negotiating ability is in the multiple that you get, but there's a range. You're not getting 20 times. You can get that out of your head right away. It really depends on the brand that you have, the growth rate that you have, and how you can position it. The cost structure that you have, the efficiency you run with, the quality of the team that you have. The easier it is to sell your product, the higher the multiple you can negotiate. The more difficult it is to buy a business like yours, the higher the multiple you can negotiate. And that's really where you have your ability. So if AI was the way it was today, and I had an AI strategy that worked, it probably would have been the same multiple. You are expected to, at any point in time, to adapt to your environment. And if you do, you will, the valuations should stay on par. It's not as if you'll be valued more. It seems to me that your business would likely be valued higher, assuming that there would likely be potential to train the AI models with your videos and produce output material. Yeah, but everybody can. That's the point about the technology, is it doesn't give me a moat. Only because a competitor can start up and use the AI technology to produce something that looks like mine. And so can everybody, right? So it lowers the overall value of the solution in the marketplace. Now, I may still be able to command a premium by saying, look, all of this stuff is verified by me. You guys use models, it's 70, 80% right, 90% right. Well, do you want to risk, let's reframe it. It's 10 to 30% wrong. Do you want to risk learning the wrong things after paying how many thousands of dollars for your exam and your prep provider? Do you want to risk learning the wrong things? I could frame it that way. But what premium would you pay over a free version? What premium would you pay over saying, look, for $26.99, I can get the AI to answer all my questions. I'll live with the 10% error rate. How much of a premium would you pay? I could probably still be a premium provider, but at a much lower price point. So I think you may have had the same multiple, but on lower EBITDA. So it would have been valued the same multiple of EBITDA, but the EBITDA would have been lower only because a lot of the industry would have been commoditized. To the point where I think in a couple of years, level one will be almost fully commoditized. Could you please share the requirements for attending the September retreat in Costa Rica? Well, there are no requirements other than a willingness to learn and have fun. Regarding stablecoins, do you think the mechanism for increased T-bill demand comes from crypto being greater than stablecoins being greater than... Oh, from crypto to stablecoins to... Okay. Following up on saying that I really don't see why someone like myself would go into stablecoins, but I do recognize that Bitcoin has a big market cap. Maybe it is. Maybe it's only the crypto crowd that will say, "Oh, this is cool, man. Look, here's a way to pay that all we have to do is take our cash, turn it into stable coins, use the stable coins wherever somebody will accept it, and then turn it back into cash." I mean, somebody will want to take the long way around when they could just do it the short way for no other reason than the long way exists. Yeah, it could be. International buyer stablecoin. I don't know why we're even worried about international buyers. Rather than fiat cash, it would have found its way into the T-bill market via other intermediaries anyways. Oh, I already explained that using the bank analogy, or the bank balance sheet example. I have read the following thesis regarding the raising the long end of the curve. I'd like to hear your opinion. Well, my opinion is going to be, that's fine. There are, I'm sure there's 15 to 20 plausible explanations for the long end of the curve. It's a matter of which one do you buy into. Long end of the curve suffering because of the fading of Doge and the proposals contained within the big beautiful bill. I've showed that Trump administration, or any other administration really, is not serious about cutting deficit and spending as promised. Yeah. Current 7% deficit to GDP is here to stay and raise, so the market is not caring about fundamentals such as lowering CPI prints, higher unemployment expectations, potential. Okay, blah, blah, blah. Okay, I'm saying blah, blah, blah because I get it. Okay. It's plausible. I can give you another explanation that's plausible. Again, when it comes to theories about what's going on, there's no shortage of them, and they're all plausible. It's a matter of which one do you believe in more. So let's say that all of this is true, and you need to hold treasuries. What are you going to do? Where are you going to go? In the end, with all the bond funds out there, they're not just going to close up shop and say, "Oh well, let's buy equities instead." They're still going to buy bonds. They're still going to do what they do. What are they going to do? You say, "Oh, well, I don't want this. I'm buying Chinese bonds. I'm going to buy Indian bonds. I'm going to buy Argentinian bonds." Will other countries, will there be more diversification away from the U.S.? Possibly. Do other countries have an advantage over the U.S. for issuing debt at this point? Yeah, the Eurozone has much lower interest rates and much higher debt borrowing capacity. Same with Canada. So there will be an increase in the amount of sovereign debt that is issued. But whenever there's an increase in the amount of sovereign debt, there's going to be an increase in the size of the funds and the amount of funds that are set up for this. That no matter what you can say, all of this could be true. But there is no credit crisis. There is no credit stress. There is no credit risk. And we just have to get through the story of, oh my God, it's a credit crisis. No, it's not. Oh my God, there's credit stress. No, there isn't. Look at the bid to cover. Oh my God, there's credit risk. No, there isn't. There's no credit risk. You're going to get your money back. And then once we get through all of that, we look at 5% yields and say, this is pretty good. We just got to get through the story. All these stories are plausible. I'm sure they are. When it comes to the long end of the curve, deglobalization, increased protectionism appear large potentially inflationary forces that can rationalize at least some of the duration expectations. Where's the inflation? We have had this reversal, this nearshoring since the pandemic. You've had countries that are looking at bringing things online. You've had inflation because the whole supply system shut down. Where is it this year? somebody was talking the other day about on Bloomberg about you have increase. What if you have an increase in consumer demand? Well, what do you have now? You have low unemployment. You've had robust consumer demand. Retail sales yesterday, the control group was up 0.4%. Where's inflation? Where's the inflation? Right? It was a supply chain issue because technology is productivity enhancing, productivity is deflationary. And we live in a world where the backdrop is deflationary. So there are countless plausible scenarios. I just don't buy into them. I don't buy into this one either. Deglobalization and increased protectionism, a pure inflationary. I don't buy into that either. Given the monetary easing that's driven huge multiple expansion and asset price appreciation. What monetary easing? Who are you talking about? How do we solve resultant levels of inequality? Who cares? Who cares about, I mean, from a social, if you want to have a social welfare conversation, sure, but from a finance perspective, who cares? One solution is government intervention of some kind that goes beyond traditional taxation. Schemes to support homeowners. Who cares? I don't understand why you're talking about this. other than I mean, if you're interested in having a conversation about social welfare or social issues or the social stability of a system, sure, but that has nothing to do with should I buy bonds or should I buy equity? Who cares, right? And I don't mean that in a heartless way. I mean, it's irrelevant for the topic at hand. Topic of AI. Many organizations I've worked in, we've never been short of IQ, but we've had a deficit of EQ. Who cares? I'm sold on the ability of AI to accentuate the skills of experts, but politics, cultural dynamics, the skill to get stuff done persuasively will remain with the people who remain. Now, that'll never go away, but again, I'm not seeing the relevance. Ability to communicate an idea, story, and whatnot is just as important. Yes, and the good people will do it. The experts will do it. I think your argument is making the point of we can't get rid of the low-skilled people because they're the ones that have the high IQ, the high EQ. I don't see that. Yeah, I don't know that any of this is relevant to the conversation about what we're talking about here. I think you want to be, I don't know what the word here is, thoughtful, but finance doesn't care about your thoughtfulness. Bonds don't care about your thoughtfulness. Neither do equity prices care about your thoughtfulness, or anybody's thoughtfulness for that matter. So you can have the conversations. It might be a good conversation to have, but it's irrelevant for finance. Why is basic and diluted EPS the same for MicroStrategy despite countless convertibles? Is it because it might be anti-dilutive due to being out of the money? Well, they're losing money. Dilution will increase the denominator, which is your share count, which will always move your EPS closer to zero. So if you have positive earnings, let's say $10 a share, and your denominator gets bigger, your earnings might be $9 a share. If it's negative 10 and your denominator gets bigger, it'll be negative 9. All right, it'll move it closer to zero. You become less negative, that's anti-dilutive, so your suspicion is correct. Is a momentum strategy you're implementing a technical analysis strategy since you're only relying on price movement? Well, that's momentum. I mean, that's momentum. I mean, if a price went sideways, it wouldn't be momentum anymore, right? I mean, how do you feel about the big beautiful bill, 3.5% tax on overseas remittance transfers made by non-U.S. citizens? I don't have any feeling about it. Since you said that a big portion of your assets are managed by J.P. Morgan, that also is no, it doesn't affect anything. That doesn't affect anything. A remittance transfer, that's not a remittance transfer. No, doesn't affect me one bit. You're thinking bring back your assets in the U.S. in case that Trump decides to freeze all Canadian assets. But if you have U.S. assets and you bring them to Canada, they are still parked in the U.S. Well, that doesn't work that way. So if the U.S. decides to freeze all U.S. assets held by Canadians at the custodian level, well, the custodian's a Canadian custodian. That would be hard to do, and I don't see that happening at all. I don't see that happening at all. Who will be more valuable in the future in the AI world? A finance professional, one who is specialized in one niche, like one sector, one domain like risk management, or one who is a generalist in everything? Who will be more valuable in the future? Both. Why? You're sort of presenting me with a false dichotomy that it's going to be one or the other. I don't see why it would be one or the other. I don't see why it would be one or the other. Yeah. Don't you think being a generalist will be better, as it will enable a person to think about a situation from multiple perspectives? Why can't I be a specialist and think about things from multiple perspectives? Well, I don't understand why I can only think about things from multiple perspectives as a generalist. As a generalist, I know a little about a lot. As a specialist, I know a lot about a little. I could still look at it from multiple perspectives, though. And you're also making the assumption that a specialist has no generalized knowledge. Why can't I have both? I consider myself a generalist broadly with very specialized knowledge. Again, false dichotomies on this one. Deloitte report called 2025 Global Human Capital Trends. I saw that one. Yeah. It discusses an emerging experience gap. It points out how AI automating foundational tasks and flatter organizational structures, diminishing traditional mentorship pathways, are creating challenges for newer professionals to develop the critical judgment and higher order thinking skills. That is the risk. that is a risk. It is. Considering these, how do you think individuals entering the workforce can effectively address this experience gap and foster the development of these essential capabilities? I don't know. I don't work in organizations. I don't know how they do things. I would say take care of yourself. Don't worry about the world. Take care of yourself. Right? If you see the world going the wrong way, oh, this AI is only going to make you less capable of critical thinking later on. Let them. It'll be less crowded for you. Let them. Just worry about yourself, right? Ted Cruz said the government can save 1.1 trillion over a decade if the Fed stops paying interest on reserves for banks. No. Government can save 1.1 trillion. Well, I shouldn't say no. I think he's using simple math, and he also said that the Fed doesn't need to do it to control short-term rate since they started doing this in 2008. Well, that is true. You can use open market operations to get it done. You can be in a world of ample reserves, or you can use open market operations. So if you he's only looking at one side of it. This is the problem with linear thinking. So let's think about the balance sheet. It has a bunch of assets because it has a high level of reserves, and the Treasury pays interest on these assets, and it pays interest on these reserves. Well, if these assets weren't here, these reserves would not be here. These assets would be over here, and the Treasury would pay interest on those. It's not as if it's not as if the amount of treasuries out there would automatically decrease by what the Fed is holding. It just means that other people would be holding that. The federal debt isn't the federal debt because the Federal Reserve wants to hold a whole bunch of treasuries to operate in an ample reserves regime. And so he's sort of thinking that, well, if they weren't doing ample reserves regime, we wouldn't have the debt we have. It's the goddamn Fed that's demanding us issue a... No, that's not the case. It's that the Treasury wants to issue all of these securities out there. Well, the Fed will hold it and hold reserves as opposed to the companies holding the bonds themselves. When it does it this way, it can control the overnight rate between the 2 points that it wants, rather than engaging in open market operations. If this side, okay, get rid of the reserves, and let's say the banks were holding all the assets instead, the Treasury would still be paying the same amount of interest, except they'd be buying and selling, buying and selling, buying and selling, and the Fed would have to do the same thing, because as soon as the rate got below 4.5%, the Fed would then have to step in and start selling to push it back up. And if it got over 4.5, it would have to step in and start buying to push the price back down. That's called open market operations. By paying reserves on, paying interest on reserves, it doesn't have to engage in open market operations. So rather than letting these guys hold the assets and they buy and sell based on what they want to do, they hold the assets and just pay an interest rate. If the Fed stopped the ample reserves regimes, the need for its assets would decrease, but the amount of bonds issued by the Treasury would not change. Just who's holding them would change. That's all. So no, he's wrong on that one. He is wrong on that one altogether. I've been watching critical thinking videos. As I watch them, know more about constructive arguments, logical fallacies, the more I feel like I'm getting more averse in terms of the way I speak and write and express myself, feeling like I'm limiting myself not to make illogical or invalid statements. Sometimes feel like I'm scared to express myself, not to have poor constructed arguments and conclusions. Do you think that is something usual or not unusual to have direct watch on your arguments every time? Well, why would you want to say things that are non-defensible? I mean, why would you want to, if you're going to bet money on something, wouldn't you want to make sure that your argument for doing it is both sound and logical? Right? Wouldn't you want to make sure? Now, you're never going to be 100% sure, but you at least would recognize when your argument is built on shaky foundations. And it also helps in defending against somebody who is attacking your argument, or somebody who puts forth an argument and you say that sounds really good. You go look and say, wait a minute here though. You're forgetting about these certain things. No, I don't know that I would say, look, it's making me talk less. Good, maybe. Right? I don't know. It does make you, I think, a little bit more careful. You do think a little bit more about some of the things you say. Not every conversation you have is designed to be a logical argument from the ground up. And you're just talking with friends. That's not meant to be, you're not following the rules of debate. Sorry, your 3 minutes are up. It's my 3 minutes now. Someone asked in a YouTube live, if someone is a CFA or an expert on anything finance or non-finance related, should they use AI and debate with it so they can get to know if their opinion is something right or wrong? You said if you tell the LLM to disagree with everything you say, then it will continue to disagree with everything you say, but no matter how airtight your arguments are, yeah, it'll keep disagreeing with you. So does that mean it is useless for an expert to debate with, but useful for a non-expert? No, not at all. If your mind is not open to being changed, then yeah, it's absolutely useless to debate an AI. But if you are saying, okay, I've got my argument, where are the holes in my argument? Where are the blind spots? And it may disagree with you, but the disagreement, you might say, I've already considered that. I've already considered this. Oh, I didn't consider this one, right? You're looking for the weakness. Whatever argument you have, there's going to be somebody who will say, well, have you thought of this? Have you thought of that? You want to be ready to say, yes, I did, and here's why I reject it. Here it is, and here's why I rejected this. You don't want to be caught off guard. You think the sheer amount of money sitting passively and deploying, do you think that the sheer amount of money sitting passively and deploying DCA or contribution plan may lead to not care about economic indicators about market? Hence, multiple irrational market rally despite contra. Well, I think what you're saying is just passive funds flows. Yeah, I think, but they've always been with us. I think that has something to do with it. But I also think it is the rise of the retail trader in the last 5, 6, 7 years to an extent we've never seen before, that really has been trained to buy the dip, 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 get it, buy the dip, buy the dip, buy the dip, just keep buying the dip. And I don't know that many of them really take the time to think about the valuation. They just see the price. They go, well, it was 606 yesterday. It's 597 today. That's a pullback. I should buy the dip, because they anchor to the last high price they saw, 606. I think the market is anchored to 612. And it's 600, which means it's $12 cheaper, without recognizing, that's just price. That's not value, right? So I don't think retail really looks at value. I think they just look at price. Like there's not enough active funds comparatively to correct the market. There could be active funds, but active funds could just be on the sidelines, and which just makes the buy the dip even more relevant, because you have no one pushing back against it. Anyways, that's it for this week. It is 10:47. We got the Fed in 3 hours and 13 minutes.